Good morning, Steve Reed with the morning grain comments. Grains are higher overnight. Corn is trying to make back some of the losses from yesterday. Beans up about 3 cents and wheat's up 13 cents. On a monthly chart, Chicago wheat has finally traded over the 50-day moving average for the first time since May of 2022. Your next resistance on the wheat corn spread is around 377. We're at 252. And on the futures, it's 777. As far as the wheat market is concerned, we're putting some weather premium back on with the drier Russian Black Sea forecast. We're also putting a little bit of premium on because of the dryness that's going to occur in the southern U.S. plains. In the wheat market, we did see that an Illinois crop tour yesterday found a yield of 107 versus last year's 97. And the USDA's got a yield of 83 versus last year's record of 88. So a very good soft red winter wheat crop. We're going to have to watch pretty closely the rains that are occurring in Illinois and see if that increases some of the concern about rust and other diseases. As far as the corn market is concerned, again, there's rekindling of talk that the rains could reduce the number of acres and also the final yield, especially if we flip to a drier forecast this summer. We also note that U.S. prices are competitive to Ukraine and that Spain came in and bought some U.S. corn. Also, Mexico continues to buy U.S. corn because of the dry conditions, and we do have a big spread between private estimates in South America and USDA estimate of corn production. Private estimates are 16 million tons lower than the USDA. So I think corn prices are undervalued. We'll see if wheat prices want to add some more weather premium. Over in the beans, I think the big news overnight was China came in and bought 2 cargoes of U.S. July soybeans. U.S. is competitive in price off the P&W versus Brazil. And we've also seen some of the railroads reducing rates so that if you're buying beans from farmers, the best thing to do is put it on rail and ship it to the P&W. And see if China continues to buy more U.S. soybeans. So the soybean market at $12.40 on the July is probably a little undervalued if China comes in and buys more U.S. soybeans. Soybean oil prices are much lower than they were a year ago. We're losing oil share as far as the board crush margins are concerned. And part of that has to do with the increase in crush capacity here in the United States, not more than what the demand for the jet fuel is. Also, palm oil prices are much lower than a year ago because of talk about increased production and lower export demand. Outside markets still waiting for some key earnings reports today, and we've got the dollar a little bit higher, crude a little bit lower, and gold a little bit lower.